You know that strange moment when you log into your investment account, or your retirement account, or whatever bucket you've been slowly, patiently pouring money into for years, and the number finally looks substantial? Not fantasy-level substantial, not yacht money, not "I'm retiring next month and buying suspiciously expensive patio furniture" substantial. I mean the kind of substantial that makes you sit up a little straighter. The kind where you stop seeing the account as this vague future thing and start realizing, wait, this is actually becoming part of my life story. This is real now. And I think about this stuff way too much. My name is Threk, and I spend an unreasonable amount of time thinking about money, wealth building, and why certain financial milestones hit people emotionally way harder than they expect. Because people love talking about the first $10,000, and obviously they love talking about $1 million. But $250,000? That number doesn't get the same dramatic headlines. And honestly, that's weird. Because reaching $250,000 can change your entire financial life in ways that are quiet, powerful, and deeply psychological. It changes the feeling of money. That's the first thing. Before $250,000, building wealth often feels like pushing a heavy cart with one sticky wheel. You contribute, you wait, you contribute again, you check the balance, you squint at it, you wonder if any of this is doing anything, and then you go make dinner and try not to think about it. It can feel painfully manual, very you-powered, very "if I stop, this whole thing stops." But once you reach around $250,000, something starts to shift. Your money begins to move enough that you can actually feel compounding in a practical, emotional way, not just as an abstract finance word people throw around next to charts and coffee mugs. A decent year in the market might add an amount that used to take you a very long time to save. And that's a huge psychological turning point, because now it's not just your effort moving the ball. Your money is starting to help. That's a different game. And when the game changes, your mindset has to change too. A lot of people think the big transformation at $250,000 is purely mathematical. And yes, math matters, obviously. But the bigger shift, honestly, might be behavioral. Because once your portfolio reaches that level, you're forced to stop thinking like someone who is just starting and start thinking like someone managing real momentum. That means volatility feels different. A normal market swing that once looked tiny now suddenly looks dramatic in dollar terms. You can see your account go up or down by amounts that feel absurdly personal, enough to make you feel brilliant on Tuesday and betrayed by Thursday, which is, not a very healthy emotional system. If you're not careful, the larger number can make you more reactive, even though the right response is usually to become calmer, not louder. That's one of the hidden shifts nobody really prepares you for. At $250,000, the stakes feel higher, but the best behavior is still boring. Actually, maybe even more boring. Because this is the milestone where people are tempted to get cute. They start thinking maybe they need a smarter strategy, a more aggressive strategy, a more exciting strategy. They've built something meaningful, and suddenly they want to prove they're sophisticated. But reaching $250,000 usually teaches the opposite lesson. It tells you that the boring stuff worked, the automatic contributions worked, the diversified investments worked, the patience worked, the annoying, uneventful, deeply unsexy consistency worked. That matters because once you see proof, you stop needing constant excitement. Or at least you should. Another reason $250,000 changes your financial life is that it starts reducing fragility. Not eliminating, obviously. Life can still be chaotic. Markets can still be weird. Roofs still leak at very inconvenient times. But there's a real emotional difference between living with no financial cushion and living with assets that can absorb some shock. That difference is hard to explain until you feel it. It's the difference between standing barefoot on ice and standing on solid shoes. The ground may still be cold, but you are no longer in direct contact with every single problem. A larger investment base, a stronger net worth, a more established retirement account, whatever form that $250,000 takes, creates a buffer between you and panic. And that buffer changes how you make decisions. You're less likely to grab at desperate solutions, less likely to confuse debt with relief, less likely to think every setback means you're starting over. And that's huge, because once panic starts leaving the room, better decisions usually enter. I also think $250,000 changes your identity, which sounds a little dramatic, but it's true. Before that milestone, you may think of yourself as someone trying to get it together, someone learning, someone hoping, someone working on finances, which is a phrase people say when they're sort of half proud and half ashamed. But once you hit a number like this, you have evidence. You're no longer just aspiring to be financially stable, you've built something measurable. You become a person with financial traction. And traction changes behavior. When people feel traction, they protect it, they optimize it. They stop making quite so many random decisions just because they're tired or emotional or a little bored on a Thursday afternoon. Not perfectly, of course. We're still human. Somebody will always be one mildly stressful week away from convincing themselves they need a bizarre new subscription. But overall, progress creates seriousness. It turns vague intention into stewardship. So what should you actually do when you reach $250,000? First, don't dismiss it just because it isn't $1 million. That's a great way to rob yourself of perspective. Respect the milestone for what it is, proof that your system is working. Second, don't start improvising just because the number got bigger. Bigger balances do not need more ego, they need more discipline. Third, zoom out and clean up your structure. Review your asset allocation, revisit your emergency fund, make sure your debt, insurance, and investing plan still make sense together. Basically, act like someone protecting momentum, not someone chasing applause. Because that's really what $250,000 is. It's momentum with evidence. It's the moment your money starts pushing back in your favor. And if you're not there yet, that should be encouraging, not discouraging. The early stretch can feel so slow that it almost seems unfair, like you're pedaling a bike through wet cement. But milestones like this are a reminder that the process does eventually change texture. It gets less fragile, less lonely, less dependent on pure effort. So yes, reaching $250,000 can change your entire financial life. Not because you've made it, not because every problem disappears, not because you've unlocked some magical level where money becomes easy and stress evaporates into the atmosphere. It changes your life because the relationship shifts. Your money starts carrying more of the weight. Your progress becomes visible. Your decisions get steadier. And for the first time, maybe, the future stops feeling like something you're begging to work and starts feeling like something you're actually building.